is Akshara Menon from PMS Bazaar, welcoming you to the Fund Manager Interview Series. Today, our discussion will be more interesting on the private market space, more predominantly into the private credit. Indian private credit has emerged as the fastest growing asset class within the alternative investments to give more predictable risk adjusted returns compared to traditional investments. Vivriti Asset Management plays a key role in building institution level private credit strategies focused on performing credit and more risk adjusted returns with having a robust risk management framework. Today we're going to have Mr. Raghunath, Senior Portfolio Manager at Vivriti Asset Management, to talk on private credit markets, how it is constructed, and how should investors see this asset class. Welcome to the show, sir.
Thank you. Thank you for having me here.
It's always a pleasure to have a non-equity person onto the terrace because generally everyone knows about equity. Yeah, but last year wasn't that great for equity though. But still, I just want to rope someone who can talk beyond equities and can think beyond the asset allocation that is there. So with regards to that, let me put my first question in terms of investor interest towards private credit. So let me start with very basic, from an investor perspective, who have just invested only in equity. So for him, last year wasn't that great. So if you want to shift to the allocations of private credit or private investment, private market, what are the things that he should, be mindful of? What is it? Will make it interesting?
Yeah.
So I think you start off in the right context. Equity has been the face of Indian investing, right? It's been overrepresented in the markets. If you take any investor, typically investors follow a barbell strategy. On one end, they'll have equities, which is extremely high risk, but also provides the upside. On the other end, they would invest in FDs, like fixed deposits, which are extremely low risk, but it just gives you inflation beating returns, right? Earlier, the market did not have too many opportunities. At best, you would have had a debt mutual fund, which could have given you 100, 200 basis points of pickup compared to the fixed deposits. But today, private credit has become a mainstream option which solves for this, right? So I would place this somewhere between the FDs and the other extreme, which is equity, which is the returns that private credit provides are equity-like, right? Mm-hmm. But the volatility is much lower, right? So what we call this is predictable and periodic returns, right? So that's the mantra of what we call performing private credit. So which means that over a 3-5 year horizon, the capital will be locked, but you get periodic returns of, let's say, approaching mid-teens, right? So that's not something that the equity market has also been able to deliver on a year-on-year basis, right? Of course, you will have phases where there will be significant outperformance, but private credit today, over the last 2-3 cycles, has continuously performed this way. And so I think investors should definitely have an allocation to this. Obviously, this is coming within the AIF umbrella, so which means SEBI is also particular that it has to cater to only the slightly sophisticated investors. So a lot of institutional investors and high net worth individuals find it prudent to invest in private credit.
Yeah, and when you talk, you just spoke about the deals and like last few cycles have been very great for private credit. There was an article that I read from EY stated that Indian private credit had sourced the big deals and majorly from big institutions. And let me not take the names, but and do you think there's a less of deal because whether one institution has taken a bigger deal, it has shown almost approximately 53% year-on-year growth in last particular year. So do you think that because of institutional coming in, the investor participation has been reduced or is concentrated, and how does that?
No, I think the market overall has grown. There is no debating that we have been in the thick of action. We have seen the number of deals that come to our desk, for example, right? We see more than 200 plus deals coming to our desk every year. Mm-hmm. For us to evaluate, we set out to do at least 15 to 20 deals, right? So that's a volume of deals that are coming in. You are right in saying that there are 1 or 2 large deals that have been in the news. I think everybody is aware of which large corporate groups have borrowed private credit. So those are genuine large deals which have found place in the funds. We have not chosen to invest there, but the market has invested, right? So the large deals are also there, but what some of these reports miss is the wide number of mid-market deals a lot of it don't get covered as well, right? If I take our portfolio, I don't know whether a lot of this already accounted for in the market data, right? So a lot of mid-market deals are there, not visible, but just adds up to the numbers significantly. The right metric I would say is how much amount of capital has been raised and deployed by private credit funds. That's gone up, I would say 10x compared to 4-5 years back, and that has been deployed somewhere, right? There have been deals that have been continuously increasing, and what I observe is that we also have other metrics to track. How many NCDs or bonds are issued by the lower rated issuers, right? So that number, if we take, that's constantly increasing, and this is put out by SEBI every quarter or so. That number is also constantly increasing. So bottom line is, I think the number of deals are increasing, and so there's more capital coming into private credit, and it's a virtuous cycle, right? So there's more capital coming, so there's more flexible capital available. More and more stronger companies, middle market companies are choosing to borrow from private credit rather than the traditional sources of NBFCs and banks. So there are headline grabbing deals, but I would say there's a broad-based growth in the market. Enough number of deals for everybody.
Yeah, when you say that the n number of deals in the market, so how do you pick and choose? That is the criteria, because equity everyone knows. It is to private credit. What are the, apart from credit ratings of a company, what else that you want to see to pick a deal?
Yeah. No, and that's the trick of the game, right? Because see, for the key difference between debt and equity, of course, we always know that equity has unlimited upside, right? So even if, let's say, out of 10 stocks, 6 or 7 underperform, the 2-3 winners can carry your entire portfolio and give you outsized returns, right?
As debt fund managers, we can't afford to
Not
invest.
last year. Last year didn't happen.
In good years, I'm saying. But as debt fund managers, we can't afford to make a single mistake because our upsides are capped, right? So which means that
the first and foremost thing is downside protection. We cannot afford to have any mistake in the portfolio. Number one. So number two, there can be various degrees of correlation to various markets. So in a portfolio, for example, we have guidelines to say we cannot invest in more than X percentage in a particular sector, right? So that there is no correlation, etc. We avoid some certain segments which are going through some kind of economic stress. Ultimately, the credit selection at the point. So see, there is also a school of thought that the management of the credit post-investment, you can exit, right? That means that you can get in without the adequate amount of due diligence. But we firmly believe that the best time to exit is at the earliest, right, before having done the deal. So to that extent, we spend a lot of time. I think every deal goes through 2-3 months of rigorous due diligence, and most of this is in-house, right? So there is also outsourced due diligence that is there in the market. A lot of due diligence we in-house, right? We do it ourselves. There's no substitute to that. After rigorous due diligence, only few companies pass our credit filters, right? Like I said in the beginning, more like 200 deals that I did this, right? So we have to pick only 1 out of 10 deals, right? And so that gives us the flexibility. So which means our constant focus is to widen the top funnel, right? So that we don't end up with having only 10 deals and having to wait. There you will face issues because of adverse selection, right? So the constant endeavor as a team is to widen the top funnel and then be extremely focused. No amount of deployment pressures or anything else will sway us in kind of choosing a bad deal, right? A bad deal is a bad deal in any circumstance. So that we'll have to attempt.
So, as you said that, exiting before entering the deal is the best exit.
Yeah.
But in terms of investor, liquidity always matters. He has entered the fund, but at one point of time, if you want to exit it, liquidity is always issue in this private market thing. So if you want to address that particular point for investor, what would that be?
That's precisely why this vehicle has become very popular, right? There is no mismatch in expectations. So earlier, this private credit was being done through the debt mutual fund. Every mutual fund used to have a credit risk fund. It was being done through that. But their investors had a different mismatch. When they wanted to exit, their investment portfolios were not built to exit one day, right? Here, we go in when we meet investors, the first thing is to say that your capital will be locked between 3 to 5 years. So there is no substitute to that, right? So it's a closed-ended vehicle. So everybody is clear from day one. So we build our portfolios also accordingly. Between the last 1 to 2 years, there is a defined exit window where we exit all our positions, the deals mature, and we return the capital to investors. So while I will not say that there is any liquidity possible in the fund. It's just that the expectations are set accordingly. This is a closed-ended vehicle, and this is the right vehicle for credit, right? Which means that because if you go and press for liquidity, right, sell an instrument at the wrong time, a good deal also becomes a bad exit, right? Because it's not a liquid market. So today, unlike in the West, for example, private credit is also actively traded. In India, this market is just beginning, right? It will get there in 10, 15 years. But today, we cannot exit a position. There are not ready buyers out there, right? So a public bond can sell, right? But a private credit transaction where we have underwritten it bespoke, right? At the same term, somebody has to be ready to buy. So it's cannot be done in a day. So that's why the vehicle is closed-ended and it will stay so. But the investors are taking an informed decision on day one, right? And nobody is investing their entire corpus in this. Everybody allocates a right amount of capital, which is not their liquid part of the portfolio, which can stay invested and earn their extra returns.
Yeah. So when you say that the investor take the informed decision of having, he knows that it is illiquid, correct? So similarly, he knows what kind of returns he can expect from this particular,
Correct.
unlike what his equity is. But past years, like 5 years before, the expected IRR was like 16, 17, 15 to 17%. But today at current scenario, it's somewhere around 13 to 15%. So we have, IRR has been reduced.
Okay.
So do you feel that it's quite concentrated, or you feel that alpha part is being narrowed in private markets?
Okay, so I'll answer this two ways. One is what is happening in the market and what, for example, us as a house we are doing, right? There is definitely some yield compression on two counts. One is that of course the market interest rates have come down, right? RBI has cut rates by more than 150 basis points. So yields are bound to come down, right? So that's number one. Number two, there is competition. So there are more and more funds that have come up, so which means there has been some yield compression. But does that mean that every deal in the markets is seeing that compression? No, right? So there are pockets, for example, every large private credit player who's, let's say, in the second or third vintage of funds has established their own niches, right? So we have sectors where we are the first port of call, right, for issuers trying to work. So there, we just go in, structure a transaction and do it, right, without even the next competing term sheet coming in. So to that extent, there are certain pockets where yield is still there. So now, why are the yields? I don't know whether you have seen a cross section of fact sheets to substantiate this overall yields coming down. But if it is, I think the key reason is also that. So us as a house, what we have done is basically also move towards slightly larger companies, right? So as private credit space has grown, many more slightly, I would say, larger mid-market companies have become open to the idea of borrowing from private credit. The macro environment is slightly volatile. So today, with all the tariff shocks going on, etc., we prefer to invest in slightly larger balance sheets, right? So at the expense of maybe 100 basis points of extra yield, we prefer safety, right? So that's why maybe instead of a 16, 17, we are closer to 15. This is Vivriti as a house. That's where we are, right? Will the yields get compressed below this? I don't think so, because there are enough pockets within the market which will give us yield by taking the right amount of calculated risk.
But saying that, sectors always play you can't have, too many deals in one sector.
Exactly.
That happens in everything. But in terms of private credit, what kind of a sector is doing good? Probably I can put it this way. What sectors is Vivriti looking into in private credit space?
Yeah. So see, we are again a sector agnostic fund, so we play across the spectrum. We don't want to be bound to any sector as long as it's diversified and we are playing in the right segments of the economy. We are happy. Having said that, like I said, there are always some ready. Also, for example, infrastructure and real estate is a ready capital guzzler. There is enough and more capital needs at any point of the cycle. So that's there. We have been very big on infrastructure, not as much on real estate. Real estate, maybe we can do industrial, commercial real estate, but not as much on the residential real estate side. On the other side, what we have observed recently is now a lot of big market corporates, right, manufacturing companies, which are embarking on their next phase of growth. There are many PLI schemes in many sectors that the government has come up with. 2 years back, there's a mad rush of deals in the renewable energy space. Every solar module manufacturer was trying to raise capital from the private credit space. So a lot of these transactions in these segments are very, very live and active. Uh, Beyond that, again, as a house, we don't want to be straitjacketed to say that we would do only these sectors. We follow the deal flow, right? Beyond this, we also keep adding to expertise. For example, financial services, renewable energy, infrastructure are areas where we would claim to say that we have done enough and more number of deals. And today, the focus is more on manufacturing, right? So that's the theme of the market, and that's where we are also very active today.
Okay. Generally when you say that you want to have, lend thing, but it is always compared to a bank. Enter this private credit space when rather going to a bank to for loan because, but from investor perspective, banks are giving the information more available. I would say the information is more likely to available to everyone in the market. It's more public, I would say. But in private market terms, it's only to the investor community. So do you feel that there's a gap, and if private credit comes and going to give the information to public, and will the source of capital increase for private credit?
No, actually, I'll contradict that because see, there are two ways to see this, right? One is the data on investment. So let's say you are a depositor in a bank, right? You are effectively giving money to the bank. What does the bank give you in return? Do they give the entire set of investments or loans they make? No, right? Whereas every investor who has invested even a small amount in our funds gets the entire list of all investments we have done in the investment thesis, right? And quarterly reports on how each company is performing, right? Not a select set of companies, all companies, right? So disclosures on investments and regular updates, I would say, is actually higher here to the guys who have actually invested, right? So that's number one. But if you apply the public market lens and say that, okay, let's say as banks do really well on regulatory reporting, which is basically RBI's lay down guidelines as to how NPAs have to be reported and the ECL provisions and all of that, right? Private markets globally, that's been the concern, right? To say that people find it difficult to judge how a fund is performing, right? Because it's not as transparent as a bank in terms of the regulatory reporting. But again, good, at least in India, what we have seen and also what we practice is full transparency to our investors in terms of the performance of all our portfolio. And today we are in the third set of funds, right? Which means the first two funds we have actually invested and exited and given updates to investors accordingly. Right? Even where there is slight deviation in performance, we actually update. And there's a standard set of procedures in terms of valuation, etc. Because in private markets, the valuations are slightly opaque, right? Which means you can claim that the every bond is at par valuation, even though there is stress at the back, right? So that's the key thing, right? So we have inset triggers internally to say that on rating downgrades, etc., there has to be a markdown of the bonds, which triggers a communication to investors to say that there is a markdown, there is some issue going on, but at the back end we keep trying to recover the 100% of the insurance. So I would say disclosures on this front are slightly poorer than the banks, but this is a problem in the market. It's called private markets for a reason, right? So, but as every fund, so I think investors have to put in due diligence to say each fund, their past track record of actually disclosing stress events, right? Have managers been very transparent? Have they been sticking to the discipline of what they said they will do? Investment strategy versus the portfolio construction. All of that can be judged by the actual performance disclosures, right, on a frequent basis. I think this is available to investors who are looking to invest. Whether this will be disseminated in the wider market, I'm not sure. That day will come.
So probably we can look forward for that, next 5-7 years. But the answer that you said, I have one more question to ask. Is like, see, all of us are human. We might make mistakes. So is there any deal? I wouldn't call that a bad deal, but it was a mistake. When you want to exit out of it, was there any deal in the last two funds that you closed?
There have been no defaults in our with these funds since inception. Having said that, have 100% of our deals gone in the same way that we projected? No, there will always be, like you said, there will always be deviations in performance. And what has really helped us, right? And we invested, imagine in the peak of COVID, right? When there's a lot of uncertainty. And we were able to exit almost all the positions as per standard exit protocols. There were at least 2 or 3 investments where it needed extra efforts from our side to kind of go and meet the managements, and then kind of get an exit accordingly, right? Or get prepaid, right? Where we don't like how the company's performance is trending, we'll have documentary provisions, right? To say that to recall our money back or to initiate legal action, etc., even if there's not a payment default. So those are provisions that we have done, but thankfully we don't have much defaults in our track record, right? So that's
That's the best part. I think that's how risk management works in Vivriti. And of course, when you spoke about how the fund is, I think Vivriti is one of its kind to have this ESG
Yeah.
fund, and having returns and also to follow ESG and to have deals in ESG. How does three put together? How it's working actually?
So that's been a part of the org DNA from day one, right? We have always been trying to do meaningful, provide meaningful capital to our investors. I mean, capital opportunities to our investors and also capital to our investing companies, right? So we have, in fact, two sets of funds, right? So one is, of course, the diversified bond funds, etc., where it's purely commercial capital. The investors invest for return. We are investing in entities for commercial reasons. There is also a lot of ESG related or thematic funds that we run as a house, right? And that's coming in from our experience as investors. Today, we run many investors for marquee global investors who have chosen us as the manager for their India ESG strategies, right? So we run thematic funds on financial inclusion, agriculture, climate, etc., which are also in the works. Where these segments, one is our experience on underwriting these sectors, right, which is something that is known. Number two, we have a specific, a large SNIT or ESG team, which actually does a parallel diligence, right? India is a very nascent market with respect to this, but today we are one of the early entrants in this, and our team basically guides all these portfolio companies to come up the curve on their compliance standards, which makes it easy for them to access this type of capital globally, right? So we are the first port of call, but once their ESG standards are set in motion, there are today a lot of avenues for portfolio companies to borrow globally in terms of green bonds, etc., right? So that's possible. So we become like the enabler for that, right? So and this space, we see there, of course, there are global cycles as to this coming. Today, for example, the US is not pro ESG, right? So, but the ESG capital flows from many parts of the world are still flowing in, right? And we find it prudent to invest in it, and there is also commercial sense in doing it, right? So today, ESG goes in, let's say, financial inclusion, renewable energy, all of this. These are sectors which are providing commercial returns. We don't have to slightly do anything differently in terms of how we will underwrite for investing in these companies. The same parameters apply for us in the investing also. We're just going deep into particular sectors. So that's how we have, as a house, we have built credibility. And most of the capital we manage for these strategies are inbound capital, where we are chosen as the managers for very large global pools.
Also when you said that India is still a nascent stage in terms of getting private market only. So where do you find the gap? Let's not compare US or any other developed markets for that matter. Where do you find this gap between India and developed market, and where India is standing in terms of private?
Means see any statistic you take, right? So the first thing I would say is look at the size of the what is called the junk bond market in the US, right? Or what is called the leveraged loan market.
It's maybe billions and trillions of dollars, where it's only investment grade and below companies which are issuing that many number of bonds. In India, you'll be hard pressed to find even A-rated companies, right, which are generally safe, issuing bonds, right? So all the action is on the AA and AAA category. Everything below that is mostly in the loan markets, what we call loan markets, which is banks plus NBFCs, right? The private credit market is just trying to change this by bringing more and more issuers in this space into this, right? The amount of capital, I think there's some statistics as to how much of private capital, I mean, this is, you mentioned, I think 8 billion, 9 billion in terms of numbers. Compared to the banking market, today banking sector, if you take the overall loan book of the banks, this will be nothing, right? This will be a very, very small percentage of that, right? So, but the structure of the Indian economy is not too different from US or elsewhere, right? So, with more and more financialization of savings, right? How the Western markets are able to do this is more financialization of savings, and investors are choosing to invest in credit, private credit, through the private credit route rather than junk bond route. In India, also this is starting to pick up, right? more action in private credit. You would also see more action on the online bond platforms. Even retail investors are choosing to invest. So that's a welcome change. So we expect more and more capitals to start coming in, and then the issuances will come in. Today, if you go and ask a mid corporate whether do you want a bond, always the answer will be yes. Right? They are also constantly trying to diversify capital from banks, but there is just not supply, right? So that is what people like us are trying to solve. Where we are trying to bring in more and more supply of capital, which will invest in these lower rated bonds, right? Or what we call structured bonds, which are not the safest of bonds. AA and AAA are bonds which are safe, which is meant for a different type of investor, right? Investor who wants some yield as well cannot be satisfied by investing in that, and that's where we come in.
Yeah, no, we just spoke about India compared to the developed markets, but after 5-7 years, let's say after 10 years, what is the one innovation that you're going to you expect to have it in private credit? Is it like deep penetration into the current products, or it is like more of regulatory coming in and reducing the ticket size or something? It can be anything else, but where do you see the private credit coming in?
No, I would say just the organic growth of what we have started to do, right? That itself is going to see a sea change. So, if I have to think about investor portfolio allocation, right? Today, the largest of family offices or insurance companies who are investing in us, their allocation to us will be very, very small, few percentage points in terms of their overall allocation. Whereas globally, this number is in maybe 15-20%. The alternatives allocation has increased to 30-40%. Within that, there is a private equity, venture capital allocation, and a big private credit allocation. So, easily a order of magnitude increase is possible just because of increasing allocation. Not to forget the largest market movers, the largest insurance companies or largest pension funds of India have not begun to invest in this thing. So that's number one. In terms of product innovation, that's also definitely going to be there. The key theme globally in private credit has been what is called asset-backed finance, which is not corporate balance sheet lending, but you take the asset out and then fund for that, right? So, Vivriti as a house, we are very, very strong in it, and we have launched the first asset-backed fund in India, right, through the Gift City route, and that's only going to grow, right? So which means that all the retail loans, mortgages, right, any form of receivable financing, everything can be done through the private credit route. Today, it's done by specialized institutions, right? You will have supply chain financing companies, you will have factoring companies, you will have banks doing this in their own vehicles. But this is going to be a very, very big part, and that will just increase the size of the private credit universe significantly.
So one of your answers you mentioned that we have close to funds and a third one is almost on to closure sale. If I'm not wrong.
Fundraise closure is
Fundraise
closure. We have deployed 50%. The rest of it will be deployed over the next 2 years.
Yeah. So, but then, is there any deals that have been followed to the you've used a deal in the first fund also, and you use the same deal in the second fund? Is that anything?
So that's generally doesn't happen. So because see, if you think about it, a corporate is coming to us to borrow for a specific need, right? There is a specific scenario. Typically, there's like a growth opportunity which the management team or promoter doesn't want to miss. They don't want to dilute by raising equity capital. They want to raise. It's very topical. It's at that point of time, right? If you think about it, let's say there's the same company is borrowing again at high teens, mid to high teens, and 5 years. Maybe that's not the right place, right? So, mostly what we have seen is that those companies actually move out into the NBFCs and bank markets and raise their next round of equity. In fact, many of our portfolio companies from the first and second funds have now in the public markets listed, IPO'd, right? So that's the natural journey. So which means each fund will have its own mostly unique set of deals which are coming in at that point of time, right? There are certain segments where there are, like I said, capital guzzling sectors, right, where there could be some different project of a large infrastructure company which could raise financing, right? That's fine. But other than that, generally it is going to be unique deals for each what we call vintage of.
Each fund will have a unique set of deals. Of course, last calendar year was not good for equities at all. But there was a myth around the market saying that people pulled out money from equity that was putting into private markets and more into private credit. Is it just a myth or was it real? Because nothing was in papers.
No, we have seen it. See, different type of investors have different trigger points, right? So the institutional investors we track have been uh, organically increasing allocation to private credit just because of their experience of doing this, not driven by other considerations. But we have seen the wider market be driven by, first there was a taxation correction difference between debt mutual funds and private credit, right? That actually drove a lot of allocations to private credit. And last year, like you rightly said, there is always a investors who would perceive, let's say, 2-3 percentage points higher return in equities, while it's not given, that possibility is there, right? So investors may prefer to take that risk. But when the market's correct, there is always naturally more allocation that comes to us. But what we have seen is that when investors taste private credit, right, it becomes a part of their core allocation going forward, right? Once the equity market picks up again, doesn't mean that they will. So there's going to be some allocation to private credit because they know that there is a steady, predictable return that you would expect. They'll tailor their portfolio around private credit, right? There'll be equity allocation, of course. There'll be private credit allocation also. So all these interim points actually drive more allocation to us, and we kind of, as an industry, try to retain that and bring the next set of investors.
So maintaining the double-digit IRR is a challenge moving on.
IRR, deal IRRs?
Deal IRR.
No, I don't think so. It's like I said, enough supply of deals that are coming in. Every cycle will have a. So, for example, the gross IRRs, what was printed in the sales decks of all our previous funds may not be the same as now, right? Because market environment is different today, right? The yield environment is different today. But if we don't deliver double-digit IRRs, I think there's no reason for investors to invest in alternatives, right? So, to that extent, there is always there'll be need of capital, which is for which promoters and management teams are willing to pay slightly premium, right? So there'll be our job is to find the right types of deals.
Okay, I think we've spoken about a lot of private credit and private market allocation and such. To investors, like who is completely new to private market, what would that one particular advice you would say? Like if at all, if he has no idea of putting into private market, he has no exposure into private. So what would that particular advice would be?
So that's what I think you'll have to go with the right kind of expectations into private credit as a product. Like I said, all of this are true. The returns are extremely predictable, right? And you get that significant alpha compared to the other traditional debt products. But what is also true is that there is illiquidity, which I mentioned. For 3 to 4 years, the capital has to be locked and earning those returns for the vehicle to manage. And there is also going to be, so for example, the fact sheets, etc. The investments cannot be similar to the safest investments out there. Right? There has to be a basis for earning that higher returns. So, which means that to judge today, I think that the biggest thing I will say is now that there are variety of options, I would always emphasize on manager selection as a key thing. So there is enough performance data out there now that the industry has been there for some time, on choosing managers based on actual delivered performance. What is the investment strategy that is being articulated? This is what has been observed, and the transparency point that we were talking about in terms of how disclosures have been. So the right amount of due diligence on the manager, I think with that, one can confidently invest in the private credit universe, and you will also have to find your right strategy, right? So while we have been talking about private credit as a broader thing, within that there is, for example, performing credit, there is high yield, there is venture debt, there is asset-backed finance, right? Each of these sub-asset classes, I would say, have their own characteristics, right? The investor has to find their right thing that suits their needs, either their risk preferences or the asset preference, or how many years the capital needs to be locked in, and then invest. So that's what I would say. But I think for any investor who has the capital to kind of invest, private credit has to be a necessary allocation. Maybe not the core allocation, that should be still be equities, but a significant allocation which should substitute all the core traditional debt products, right?
So one question is that we have a lot of players now in private credit, which was not the case years ago. Today we have a lot of players. So how does that what make Vivriti apart or differentiated from the other peers in the market?
Okay. So see. That is true even globally, right? So globally, you can say There are many large $100 billion plus funds that are in operation. Each has their own style, own DNA, right? Similarly, we as a house, for example, we have our underwriting principles. We have the set of deals that we would prefer. This is generally known in the market, right? So while there are many funds that have come in, like I said, the funds who have crossed 2-3 vintages in this are not that high, right? So basically, I would hardly say there may be 4 or 5 of the funds that are there in the market which would have crossed those kind of vintages, right? And each of them has a unique positioning in the market. So, for example, we are known for, or what we like to be known for, are what we call cash flow underwriting, operating company cash flow underwriting, right, for growth, right? We don't do too many exotic situations from our performing credit fund, right? So this is what we are known for, right? And we have generally stick to the discipline of doing this, and we have had very what we would call slightly differentiated deal sourcing, right? We don't participate in what is called widely participated deals, the large deals that you mentioned about, right? So those kind of deals we typically don't participate because we're not in control, and we like to be in control, right? The term sheets, etc. We like to structure a term sheet. We like to do our due diligence, and we like to be the single guy or maybe out of a club of 2-3 funds mostly, right? Who are there with the borrower through the cycle so that we can also exit, right? If you're one among 100 people, you may not be able to have the preferential exit that you want, right? So these are the things that we like. So which means that we have a unique set of deals that we go after. Our fact sheets have generally been known to be very unique in terms of the type of companies that we invest in, and of course our performance track record is there for to be judged, right, on that. Through this differentiated route, we have been able to deliver similar returns, or what is the committed returns to our investors.
So, as you answered, this question is completely out of curiosity. So, for one, as you said, you have 200 deals, 400 deals in the market, accepted. So, for one particular deal, there are a lot of competitors coming, a lot of other asset managers coming in to get that particular deal. So, how is that the Vivriti is going to take that deal?
Not just this is the challenge that we are on daily, but
See, this is the reality of the market, and for the good deals, there'll always be competition, right? So we'll either we can choose to do our unique deals, which is also great, but we also want to participate in multiple deals that are there. So to that extent, there'll always be competition. So there are different things, right? So one is, of course, what we can offer optimized through structurability, right? So while everybody will structure the transaction slightly differently, are we able to understand the issuer or promoter's requirement exactly and offer the right solution? Typically, it's like 1 or 2 things can swing the deal, right? In terms of, I'm not talking about pricing alone here. It's been structure, maybe collateral, maybe the cash flow schedule that you're giving, right, or your prepayment structure that you're giving, etc. That can swing the deal, right? That's number one. Number 2 is what is the confidence that you're conveying, and do people, because like I said, companies borrow this capital at their critical growth juncture, right? There's something in front of them which means that it's time bound. They want to do something, right? Either acquire a company or set up a plant or do something, okay? So they also need confidence that the fund in question will deliver, right? There is a due diligence process, etc., but it's the team grasping the right things and then wait. So in fact, many deals where issuers actually choose us as a team, even if the deals are the term sheets are the same, right? That is number one. And number 2, we also do we go all in. There are multiple ecosystem, partners, etc. So we work with many market intermediaries, investment banks, etc. Where we have again relayed this confidence that we, if we like a deal, we can do all our due diligence and then quickly provide the right solution. Once this confidence is relayed, more and more people approach us with the intention of closing a deal, right? Not with the intention of shopping for deals, right? So to that extent, we try to avoid positions where we are competing. But even if we are competing, we have enough, I think, weapons in our arsenal where we can win deals. Of course, we lose certain deals as well. There's when I say when we lose certain deals, we win a lot of deals. So to that extent,
so that's why our pipeline has always been fairly strong. Right? Today, like I mentioned, we are on the verge of maybe in the next couple of quarters we'll complete full deployment of our third set of funds. Right? To that extent, we have always been successful in winning deals over others and closing.
Okay, so with that, we have come to the end of the session. So I would like to thank you for educating, the investors on the private market and more predominantly on the private credit side, and how good the allocation would be, and like how could they predict the returns, and also what expectations they can come into the market. So most of the we have covered it in this thing. And for the one last closure note, is there anything that you want to convey to investors?
No, I think it's more of the same. See, like I said, the key junction, we are at this juncture because some of the initial set of investors chose to believe in a new asset class, right? And today it's become mainstream, right? And that's exactly what I think investors have to come out. There's a wide range of products available. There has to be shuffling between products based on, like you said, equities, etc. There's always some shuffling between products that is required. But I think more and more people have to experiment, allocate, and that's really happening in the Indian market. And we're all thankful for that because earlier it used to be only real estate, physical assets, and some amount of equity exposure. Now I think it's become more and more mainstream. More and more investors are taking advice, right? So there are many wealth houses, investment banks, etc., who actually evaluate managers like us, right? And they know who are the right guys. So they have to take advice, right? Because that's financial investing is a very critical part of any investor's this thing. Even if you are a sophisticated investor, unless you are doing this full time.
Okay. So then, I understood that, 20, 25 years before it was real estate and gold, which was mainstream, and then for the last 10, 12 years, it was equities that has been mainstream. So now private credit has been, it's tending to be the, mainstream source of things.
Yeah, private credit for the sophisticated institutional investors. For retail investors, I would there are of course a lot of bonds that are available where bond investing is the first taste, right? After that, of course, private credit solutions can also be accessed today through a different route, even at a lower ticket size. That's the SEBI has also provided different avenues to do that. So I would say even for retail investors, bond investing is an important part of this. Again, invest after a fair bit of education and also have to take the right amount of financial advice.
Yeah. So with that, we have come to the closure. Thank you all. Thank you for your patience. And I would like to thank you for educating us as well.
So thank you so much for having me. And it's always a pleasure to have these conversations and educate more and more investors about the private.
Thank you.
Thank you.